Greetings. We are back with June's monthly video commentary. This is filmed on Monday, June 27th. So if you see some data that might be a little antiquated by Sunday or Thursday, depending on when you're watching this, that's the reason. I'm really excited for today's video. There's a lot of good stuff. We'll be covering what's happened so far this year. You know, the Fed's kind of talking about a soft landing. I think the landing we've had has already been pretty hard. We'll talk about what makes a bear market, and we'll kick the tires on the 14 bear markets we've had post World War II, and then chart future returns from that. It's a deeper dive on my last blog post from last Thursday. So if you caught that, this will provide some context for you. And then I've weaved in some interesting data points as well. So I'm excited to present this. Hopefully you get something out of this, and let me know if you have any feedback. So I'm going to share my screen. And hopefully I've worked out my pointer issues. You should be able to see my face in the lower left. That could be a good or bad thing, depending on if you like to see my face when I talk. Okay, let's get into it. All right, so I've shown this chart a few times. This is the S&P over the last 5 years. We're officially in a bear market. I know people like to talk about bear markets and recessions and all that. So for those that have been tracking this line, we are officially in a bear market. So this was the all-time high. We would have to gain about 31% to get back to this all-time high. And of course, we breached the magical 20% drop mark. And we're almost down to the pre-COVID high, which we hit back in, call it February of 2020. Although the S&P is down a little over 20% on the year, this is an interesting look for those that pick stocks. So a lot of do-it-yourself investors, a lot of brokers actually pick stocks. And they build these stock positions as the core of their portfolio. And this shows the Russell 3000 index, which is basically a snapshot of the US stock market, and shows average distance from 52-week high by sector. So you can dig into this and see the various sectors and where they're at from all-time highs, or 52-week highs. But what this tells me is that for folks that pick stocks, the average stock in the US stock market is down by 44%. So the range of outcomes when you're picking stocks as the centerpiece, as the focal strategy in your portfolio, means some years it might work out in your favor, and some years you're going to wildly swing and miss. And again, although the S&P is down 20%, if you're picking stocks, the average stock is down 44%. So that's why I mentioned, when we talk about consumer sentiment, investor sentiment, a lot of investors feel very poorly now. And a big reason is they piled into the best performing stocks of yesterday. And you can see if you're leaning the wrong way, or you chose the wrong stocks, or you had a heavy position in tech, you're probably hanging out in this neighborhood here, which doesn't feel good. And you can actually see the average technology stock is down almost 50%. That hurts. So back to my opening comments, the Fed keeps talking about a soft landing, and you might hear this in financial media, this soft landing narrative, meaning the Fed is able to gently raise rates without triggering a recession. I would argue we've already experienced a pretty hard landing, and I'm going to show you some eye-opening stats here. So the US bond market losses are approaching $3 trillion. And you can see, going back to 1976, we really haven't seen anything like this for a long, long time. So over the last, call it almost 50 years, interest rates have steadily gone down in this country. And as interest rates go down, bond prices go up. As bond yields go down, bond prices go up. So bonds have had a secular tailwind as interest rates have steadily gone down in this country. Secular theme has shifted, and now yields are starting to tick higher as the Fed combats inflation. What it's resulted in is the steepest losses in the bond market that we've seen in almost 50 years. And a lot of retirees, a lot of pensions, a lot of nonprofits, a lot of big pools of capital own bonds. It's one of the biggest asset classes on earth. It might even be the biggest asset class on earth. So this truly stings. Looking at equity market losses, okay? Russell 3000 market value drawdown in trillions of dollars, again, since 1976. We're close to what happened during the COVID sell-off. Looks like we just went past that. And then back in 2008, the financial crisis, we've surpassed that as well. So When you combine the losses in US equity markets and the losses in bonds this year in 2022, and we're only in June, that equals the largest destruction of wealth in modern history. So again, I would argue this has been a very hard landing. The wealth destruction, almost $15 trillion, is substantial. So I kind of chuckle when I hear this soft landing narrative. Investors are feeling the sting, consumers are feeling the sting, and I think this picture is worth 1,000 words. Looking at the 60-40 portfolio since the 1970s. So 60% stocks, 40% bonds. This is a very popular asset allocation, and for good reason. For a long time, it's really helped folks that are retired or living off their portfolio to generate a meaningful return while being mindful of risk. And again, this is why people feel so bad this year, because a lot of retirees own bonds. A lot of folks own the 60-40 mix or something close to that. And you can see in 2022, we've just posted the second worst period for a 60-40 portfolio since the 1970s, down about 18%. And we're getting close to what the 60-40 portfolio posted back in 2008. So if you're wondering why your balanced portfolio is down, or your 50% stock and 50% bond portfolio is down, this is why. This has been a tough year for all asset classes. So it turns out that higher inflation and higher rates are bad for most asset classes. There's been very few winners this year: gold, commodities, energy/oil, and the list is pretty small. Sentiment. So this is a new spin on sentiment. So we're tracking bearish sentiment. Okay, so when this line goes higher, this blue line, that means people feel the worst. People are pessimistic. They think the market's going lower. Okay, there's a couple interesting things here. One, bearish sentiment was at a all-time high back in the spring of 2009. So in the middle of the financial crisis, this peak actually marked the low in the S&P 500. So as you can see, as this spiked to the highest level, the market basically went straight up from there. And the reason why I bring this up is because we're not at these extreme levels yet with the bearish sentiment, but we're getting close. So fast forward over here, this is 2022. Bearish sentiment is creeping higher. I mean, it's basically shot straight up over the last year or so. This is something I'm watching closely, because when people feel the worst, future returns are often the best. And we can flip that too. So back in the middle of 2021, market was humming along. You can see it basically went straight up. Bearish sentiment was at cycle lows. Okay, so you could go back to late 2017, early 18, and we were at close to cycle lows, but look at what happened. The market basically went straight down. So stability breeds instability, and then flip that, when things feel the worst, things often get better. I'm not saying that's going to happen this time, but humans are terrible at predicting inflection points. So large changes in markets. Historically, the data backs that up. So this is a Google search term. So people are searching recession more than they have in some time. This goes all the way back to 2004. It's kind of hard to see, but recently you can see this uptick in people looking and searching for a recession. And this is in the mainstream. So I think Cardi B, who's a female hip hop artist, posted on Twitter that we are in a recession, or asked about a recession. So that might be a contrarian indicator, but this hot recession talk is very much in vogue. And again, I always get skittish when everyone agrees, or this becomes a mainstream narrative that a recession is a certainty, because it's certainly not. So this is just an interesting soft data point, if you will. So this is a chart published by the Atlanta Fed trying to predict changes in economic activity. A lot of people watch this to see if we are going to get a recession. And in the first quarter of 2022, we did get a negative GDP print. Okay. From the academic side, a recession is classified by 2 consecutive quarters of negative GDP growth. This is predicting we are close to the academic definition of a recession in the second quarter. And this is the zero bound here. If we get below this line, that would trigger a quote unquote recession. So again, this This is just a projection. This Atlanta Fed is actually not very accurate. A lot of people do watch this, and a lot goes into this too. So they take average forecasts from the highest predictors of GDP growth and 10 forecasts from the lowest predictors of GDP growth, and they try to mesh those together and get a consensus, and then they track various data points in real time to try to capture the consensus forecast versus what's actually happening, hence the GDP now language in the title. Okay, median S&P decline in post-World War II bear market. So I think post-World War II, there's been 14 bear market declines, again, defined by a 20% drop in the S&P. This is the median decline with a recession. There's been 8 instances, right? So a recession and a bear market. The median drop in the S&P is about 35%. For context, we're about right here, 22%-ish on the S&P. So if we get a recession, the S&P could potentially drop a little bit further. If we don't get a recession and we hit a bear market, which we've already hit a bear market, then the S&P drops about 28%. So the median drop is about 28% with no recession, median drop of about 35% with a recession. Median length of post-World War II bear markets. So if you're wondering how long a bear market would last, again, we break it down post-World War II again. With a recession, the bear market lasts almost 500 days. So what is that? Like a year and a half? Without a recession, bear market lasts 198 days, which would be a little more than half a year. So if we hit a bear market, let's see, in early June, this could last for the remainder of 2022. Again, you can't set your watch to any of this. We're just giving you context based on history. So in summary, things are a little worse with a recession and a bear market. Things are a little better without a recession and a bear market. Post-World War II, 14 instances of bear markets. Okay, so this might be a little small. You can blow it up on your screen. So again, 14 bear markets post-World War II. So we're going all the way back to 1946. You don't need to digest all of this, but average change for a full bear is about 32%. You can see some are a little bit worse. Some are a little bit better than the historical average. No one knows what 2022 has in store. Average days, 339 full bear number of days. So on average, 32% decline, about a year. What's interesting is future returns once we hit that bear market threshold. And we chart this next week, next month, 3 months, 6 months, and next year. And I know there are exceptions, but overwhelmingly, when you fast forward to the next year, future returns are higher. So on average, once we hit that bear market threshold, the S&P's up on average of 18%, a little less than 18%, and positive about 80% of the time. Okay, and you compare that to all periods since 1945, the market's up about 10%. So future returns are substantially higher than the average once we hit a bear market. Unfortunately, most people abandon ship. They're either sitting on cash and not wanting to get invested because they think it's going to get worse, or they sell out of their portfolio and wait for things to get better. Okay, that's not a good way to manage money. Things will often get better when it feels the worst. I always say this, there's not a flashing green sign that says all clear to invest. We've hit bottom. Bottoms are impossible to predict. Going back to 2009, no one cares if they got invested in March of 2009 or September of 2009. Looking back, getting invested when it felt pretty bad ended up being a good decision. Okay, I'm not saying you can't manage risk or you can't dial down risk, but making these large active bets and trying to time the bottom and raising cash and trying to guess when to get back fully invested, that's a difficult game to play. The more decisions that you make, the more likely you are to be wrong, and the empirical evidence is just not on your side. So this is a cleaner way to look at the last slide. So again, we're tracking S&P returns post World War II bear markets. So if you got invested After we hit that 20% threshold, the future returns on average 1 year later are 22% higher for the S&P. Looking at an annualized number, 3-year annualized returns of 14%, 5-year 13%, and 10-year 12%. So historically, getting more aggressive, getting invested, staying invested tends to be rewarded after we hit a bear market. So if you were lucky and happened to be holding a bunch of cash, now's a good time to look around for value. I'm not telling you what to do, but again, historically, that has been rewarded by allocating cash during difficult periods. And then you can see the light blue is for all other periods, 1 year, 3 year, 5 year, and 10 years. So again, future returns are higher after a bear market. Not to beat a dead horse, but this is pretty cool too. So we just had a consecutive 2-quarter drop of over 23%. Okay, so we basically did the same thing, tracking 2-quarter drops of over 20% post World War II. And this is eye-opening. So that's happened, what is that, 7-8 times now? And future returns over the next year are positive 100% of the time, averaging about 31%. So terrible back-to-back quarters, positive actually 6 months later 100% of the time, and the next year 100% of the time. Again, not telling you this is going to happen this time. Every cycle is a little bit different. History doesn't repeat itself, but it often rhymes. And again, allocating capital when it feels uncomfortable often is rewarded. And I should say, a lot of people might think I'm being bullish and being an optimist and I'm burying my head in the sand to risk out there. There's a lot of pain priced into the financial markets, a lot of bad news priced into financial markets. My job is to stay even keel. So I consume bearish content, optimistic content, and I try to form our own opinion. Of course, we have a framework for the way that we manage money, but my job is to not get emotional about this. It's not to get political about this. It's to stay even keeled and be a realist. So I'm not pushing you to do anything. I'm not trying to paint an optimistic picture. I'm just reporting the evidence. So I wanted to say that. Seasonal factors. So some investors really pay attention to this. I pay attention to it, but it's more just an interesting data point. So this is the average monthly percentage change for the Dow Jones going back 100 years, 50 years, and 20 years. And we're basically looking for seasonal factors, meaning what are the best performing months? And July is actually a pretty good month. So you can see over the last 100 years, July has averaged a 1.65% monthly return, positive 66% of the time. Over the last 20 years, it's had a pretty good run as well, up 1.45%, positive 75% of the time. And you can see the fall is actually a pretty good time to be invested. Summer can be a little choppy. Of course, there's the sell in May and go away narrative. That really doesn't mean much in my opinion. So this is interesting. A lot of people want to compare this period now to 1970s and 1980s. A lot of clients say, hey, back when I got my first mortgage, rates were at 15%, inflation was at 18%. And there's this narrative that inflation and higher interest rates are destructive for every asset class. And certainly it can be volatile, it can be uncomfortable, but you can generate positive returns in certain asset classes during environments like this. So we're rolling this back to the 1970s. I found this chart on Twitter, which was a good find. So back from 1973 to 1981, inflation averaged about 9% a year. And you can see it was low, it was high, and then it was low, and then it jumped up again. So it was pretty choppy. The Fed funds rate was trying to anticipate changes in inflation, which is impossible. You can see it kind of bounced around too. And look how quickly the Fed funds rate spiked in the late 70s and early 80s. They were really trying to stomp out inflation. Consistent to what we've said in the past, during periods, the Fed is shifting. So going from cutting to increasing rates, from increasing rates to cutting, things tend to get noisy. And you can see as inflation jumped higher, S&P returns were negative, actually quite volatile, actually. So down and then up and then it's kind of all over the place. If you were to chart a range here, negative 26% to plus 37%, that's a huge range in a relatively short period of time. But overall, inflation averaged 9% a year. the S&P did 5.3% a year. On a risk adjusted basis, it was probably not so attractive because, you're getting 5%, but risk is through the roof. Bonds catch a lot of flack, but in a inflationary environment, they actually performed quite decently. So this would have acted as a stabilizer in a 60-40 portfolio. So while returns were negative in a few years, you can see the dispersion, the range of returns were much tighter than equities, which is what you might expect. Annualized returns of 3.4%. Some factors that performed well back in this high inflation, higher rate environment: higher dividend yielding stocks and value stocks. Of course, they experienced some pain, as you would expect, when the S&P was down, but they bounced back nicely. And that's held true so far. I know our sample size is pretty small this year, but value and higher dividend paying stocks on a relative basis have hung in there nicely. On the opposite end of that, more growth stocks really got crushed back when inflation was high and the Fed was trying to figure out what was happening, down 31 and 35%. That really hurts. We're experiencing something similar in 2022 with growth really taking it on the chin this year. I don't know what the AMCAP fund is, so I'll disregard that. But you can see gold, energy/oil really perform well in a inflationary environment. So the takeaway is you can generate positive returns in stocks and bonds in a rising rate inflationary environment, but things are much more volatile. Returns are noisy. The data is noisy. Value, higher dividend payers, energy, and precious metals tend to perform well. About how projecting future equity returns is pretty simple. And it's basically an inverse of this chart. So what this chart is, this is showing household percentage of equity ownership. So in other words, the higher this line goes, the more households are owning equities. The higher percentage of their balance sheet are in equities. And when this line gets high, when it peaks, that historically means future stock prices are lower. And you can see the cycle peaks here. So this peak pre-tech bubble crash, equity ownership percentage went down. This peaked back before the financial crisis, equity ownership went down. And you can see these darker columns are marked by recessions. And here we basically peaked and stock prices went down. What's interesting is this line hasn't really changed all that much, which means a lot of people are probably just sitting on their hands and doing nothing. And again, I think if you're a younger person, say if you're under 50 years old and you're still working and earning, that's fine to stay the course. But if you're a retiree or about to retire and you've been taking more risk than you set out to, you've had a big allocation to your portfolio in tech stocks, which is not uncommon, this probably is not an optimal strategy, just to sit on your hands and hope that things get better. So again, a lot of portfolios that we see from potential clients that are managed by other advisors or brokers are so far overweight in tech and are overweight in equities for how these investors feel about risk. And oftentimes they're taking more risk than they set out to, which was covered up when markets are going up. But as they get closer to retirement, as they start to understand their range of potential outcomes, they're deeply uncomfortable. And that's what bull markets do. It almost propels you to a misallocation of capital. Everybody's a genius in a bull market, and you only see who's been swimming naked when the tide comes out. And unfortunately, a lot of people's portfolio performance, a lot of retail investors' actual performance is much worse than the overall markets. So markets are down about 22%. I've seen portfolios down 40, 50, 60%. And a lot of these investors thought they were taking marginal risk. They didn't understand that that was a potential outcome. So if you're younger, staying the course is fine. If you're older, build a portfolio that reflects the way that you feel about risk, understand the range of potential outcomes, and more importantly, have a framework for paring back risk, for dialing down risk for when things get difficult. That's one thing I see from a lot of potential investors. I ask them, or I ask a question of their advisor, what's your framework for making risk off decision? Meaning, what's your framework for paring back risk in your portfolio? And a lot of times they don't have an answer. They just stare at me blankly. And a lot of advisors can't even track how much risk that they're taking to generate returns. So if you're working with another advisor, make sure that you understand performance. That's part of it. but also make sure you understand the journey, meaning how much risk, how much is your portfolio moving to generate the performance that you're posting. And a lot of investors can't find that. A lot of advisors can't find that, but it's hugely important. So this is interesting to me. So this is the US 10-year yield, and this is oil dollar per barrel. And bond yields have started to come down, and there's this hot inflation talk, like inflation is going to be a problem for a long time. That may be the case, but yields coming down are signaling a potential growth problem. All right. So I'm keeping a close eye on this. You know, a lot of people watch the stock market. Most professional investors watch the stock market, but they watch the bond market even more closely, because the bond market is the smartest capital on planet Earth. A lot of institutional investors. And if this moves meaningfully downward, that would be a cause for concern. That would basically signal a recession is coming, and that would make the Fed's job even more difficult, especially if inflation stays high. This is a welcome sign, but it also can signal, okay, so it's a welcome sign in the fact that a lot of the inflation happening right now is outside of the Fed's control. So supply chain issues, energy prices, the Fed can't directly impact those metrics by increasing rates. But a natural ebb in the price of oil would give consumers a break at the pump. This could also mean a slowdown in economic activity. Okay, so going to be watching oil very carefully, going to be watching bond yields very closely. This is kind of out of context for what I've been talking about today, but I'll be very interested in large changes in these two assets. Okay, well, I hope you enjoyed that. Thank you for watching. Thank you for listening to me. If you have any questions, feel free to email insight@pureportfolios.com. Wishing you all a wonderful and safe 4th of July. Take care.